for your industry. All right. So why do the foundations matter? You're a unique breed in regards to business owners and business cycles. So there's some specific challenges, and the biggest one, this, is fluctuating income. You can go months on end with zero income, and then other months you can make $1 million. So you don't fall into what are like traditional financial planning models because those extremes of income year over year, month over month, make it really difficult. You also all love your real estate, right? So you like having those real assets. You have these complicated structures. Maybe the real estate's in holding companies. Um, and you also seem to, I own this property with my wife and this property with my next door neighbor, and six of us went in on this property. So you end up over your careers having these complex structures with not necessarily no thought, but okay, well, what does this look like though 20 years from now when you want to sell, retire, die, and all that sort of spot? So you get a little bit of excited when you see a great deal and then you just buy it and we don't think later. So that impacts planning as well. And then those multiple corporations, like I spoke about. So lots of the agents I work with, they're very entrepreneurial. They might also be a mortgage broker or have another marketing business on the side or do coaching. And they've got all these other sources of income. And so how does that tie into a Prec or your real estate business and the rest of your life, which is unique to the mindset I find of real estate agents? And you don't have pensions, right? So other than your CPP, whatever your future looks like is totally up to you. So go all in, make or break it. There's no government pension coming in behind. So we will talk about CPP in a bit. And so that's what I do is I come in. These are the conversations I have all day, every day, and we help build plans. And my biggest job is to help you pay less tax now and in the future. Do whatever my kind of motto is like anybody but the CRA. So we're going to talk about RSPs today, TFSAs today. How do we use them strategically with or without a Prec? Even the most, I was just saying this, what I would consider very advanced investors, experienced investors, still don't understand some of the little nuances about these accounts and how they really work. We're going to do a dive into CPP and OAS and what they mean for you as a self-employed individual at the different stages of your career. And the other thing too, now that the Precs on the scene and agents have them and they've got retained earnings, I find they're sort of dropping the personal side of financial planning because they're just like, all my money's in my corp and I'm just going to focus on my corp. But your Prec isn't a substitute for making sure the rest of your life is functional and tax efficient. And then I kind of end with two parts. One is, again, I have the privilege of talking to agents all day, every day. So I can also see the biggest mistakes they make, right? There's some trends that I've noticed over the past couple of years about, oh, this is funny, I guess. We'll get that. What you can do about it. And at the very end, I'm going to go through a case study. So this is a client I helped change their names and their numbers, but you can kind of get the concept about how it ties everything I bring together. So let's do RSPs and TFSAs. I'm going to share my little camera here. All right. I'm going to scooch. Pardon? This little document camera was like the best $60 I ever spent in my business. I bought it during COVID to help talk with my clients and explain things. And now it's just, I do this all day, every day. All right. So let's start with RRSPs. So one thing for an RSP is not an investment itself. It's an account that holds investments. So some people don't get that. And they'll say things like, oh, RSPs suck. I don't believe in RSPs. My RSPs never made me any money. And it's just like, that's nothing to do with the account. It's just you happen to pick some crappy investments to put into it. So how do these work? So RSPs are based on what's called earned income. And this is an important word later on. So for those of you who do not have a Prec or have a Prec and are paying yourself a salary from it, not a dividend, you're generating what's called earned income. So let's pretend you make $100,000 in a year. The rules around RSP allows you to take 18% of that every year, so $18,000, and put it into one of these accounts. By doing that, instead of paying tax on $100,000, you're now paying tax on $82,000. So when it comes to tax, the simplest way to understand is you either pay tax going in or you pay tax coming out. That's it. So with RSPs, you don't pay tax going in. So you put the $18,000 in there and you haven't paid any tax on it. So that means when you take it out later, you do have to pay tax on it. But by doing this, this saves you in the year that you do this about 5K in income tax that year. One of the things about it, though, is this 18% does max out. So if you make $1 million in a year, that doesn't mean you can put 18% of $1 million into one of these accounts. It maxes out at about 30K per year. And also, too, I round all my numbers. Okay. I'm teaching general concepts here. I don't do decimals. So that's how it works. This amount does carry forward year over year. So if you don't have the $18,000 that year to put into it, it carries forward and you can just find on your MyCRA online how much contribution room you have. So let's pretend we do this and we put the $18,000 in this account. Great. It's in there. Now what do we do with it? You invest it. Okay. Pick your investment vehicle of choice, GICs, ETFs, mutual funds, stocks, private mortgages, depending on the private mortgage lender. Whatever it is, you invest this money. Okay. And it's going to grow, ideally. And let's flash forward 40 years, and you've now got $1 million in this account. And you've been topping it up every year, and you put your money in. There's $1 million in there. Great. You've never paid a dime of tax on this the entire time that it's been in there. So how does it get taxed when you take it out? A couple things. You can control when you take it out up to age 71. So between however old you are now and age 71, if you want to do a full, like if my clients have their RSPs with me, call me like, Joe, I want the $1 million in my RSPs, give it to me. You can do that. You're going to pay a 54% tax rate on it because it's going to show as all that income in the year that you took it out. Whereas if you took out 10 grand a year or 20 grand a year, it just gets added on to whatever other income you made for that year. All right. So then what happens is at age 71, the CRA says, you've had all this money in here for a couple decades. You've never paid a dime of tax. We don't care if you want to take it out or not. You now have to start taking it out. And at age 71, the account gets converted to something called a RIF, a Registered Retirement Income Fund. So it's just some account paperwork. Your advisor just changes the account name. And I think you can no longer contribute to them now. So some agents that are still working in their 70s, you now don't have this 18% you can keep putting into it. And it's not uncommon for agents to still work in their 70s and do a couple deals, but you now don't have this tax sheltered vehicle and you have to start taking it out. So it's called a RIF minimum. And the amount that has to be withdrawn, it's a calculation. It's a formula that the company that your RSPs are at will tell you it is. And essentially, it's however much is in the account divided by 90 minus your age at the time. So every year, the year you turn 73, they'll say, okay, you have 500,000 in your RSPs divided by this. This is how much you have to withdraw this year. So what does that mean is if you have $1 million in your account this year and you're 65, when you're 71, you're going to have about 40K of income you're going to have to withdraw that year, which is fine. But the other piece you have to keep in mind is this is still invested and maybe growing. So the RIF minimums, if it's still invested and growing, you'll still never deplete the account, right? Like it could just be the interest that you're pulling out of it. So the accounts can still grow in that time frame, which is a good segue into the next part about what happens to these accounts when we die. I talk to a lot of agents or just people in general that are in their 60s and they're like, I don't want to pull from my RSPs because there's this mental stigma that RSPs are for retirement. RSPs are for old people. If I pull from my RSPs, it's like this same as reason why people don't get wills. It's like this sort of mentality around it. But like if you die with money in your RSPs, it's as though you did a full account withdrawal the day before you died. So if you die with $1 million in your RSPs today, it's as though you did a full account withdrawal the day that you died, and all of that gets added to your taxable income for that year. So now it's taxed at 54%. If you have a spouse, sorry, let me clarify. So if you have a spouse, it can roll over to your spouse tax-free. So that's fine. Spouse will roll over, but now your spouse just has to deal with this. And if they have RSPs, now they have their RIF minimums coming in as well. So the goal is to just never die with money in your RSPs and have an exit strategy for them so that you get it out. So even if you have kids on as the beneficiary, so some people say, oh, Joe, it's okay. My kids are the beneficiary of my RSP. I'm like, that's fine. But the tax is going to get paid before it goes to your kids. So when we're doing estate planning, And I've had these conversations with agents, and this is a really good example. This one agent, they have about a $6 million real estate portfolio, and then they also have about 6 million in assets. There's capital gains owing, and her son's in the business. And she's like, when we die, my son's going to get all the properties, and my daughter will get all our cash. And that should be about equal. But the bulk of their wealth was in RSPs. So when we actually calculated their terminal tax liability, which is how much tax you pay when you die, there was about a $600,000 difference between the two because she didn't realize that this would have to be paid tax on before it moved over. Okay. Um, that's kind of it for RSPs. That's the Coles note on it. You can do income splitting from these later on. So after age 65, if you have a really big RSP and your spouse does not, you can start withdrawing and split the income between the two to make it smooth out. But that's sort of it on the RSP fronts. Questions, comments? Yes.
What was the formula you said for the RIF when you turned 71? You said divided by 90.
It's the amount in the account
Right.
divided by 90 minus your age.
Oh,
So, and don't necessarily worry about you having to like the fund company or whoever your advisor is, a ballpark going forward.
Example that we said, the money goes to the daughter, the house goes to the,
Yeah, the sons. Yep.
but both has to be taxed.
So the way, I mean, that's not the case study I have in here. I'm way oversimplifying it for explaining that. They had some of the properties in holding company, and he is the shareholder of the holding company. There was some capital gains to be paid on that as well. But even once, so I use a planning software, we put all this data in there and we can project forward. So even once all was said and done and taxes were paid and he bought out her shares and the daughter got the cash because she doesn't even live in the country, she's in a different country. There was it's just it wasn't as simple as what they thought, right? They're like, he's in real estate, he's here with me, he's a landlord of these properties. It's about the same, but it was not about the same. Well, I don't know. I don't think $600,000 is about the same between two siblings. No. Okay. Yeah. I have 5 kids. If I was just like, one of you is going to get $600,000 more than the rest, I don't know that that would really. Yeah.
Sure. I would think.
Yeah. Well, and then in their situation, like I said, the daughter's not even in the country. She has no interest in the real estate. There's 2 cottages. She's just like, yeah, and she's like, she'll take the money and invest it and grow it, whatever. Okay. Yes, I'm talking to a room full of real estate agents. You're like, take the real estate. Yeah. All right, so let's talk about TFSAs. So these are the most underutilized accounts in Canada. I'd say if there's one error I see all Canadians making, it's around tax-free savings account. And there's a couple of reasons for this. One is it's because it has the word savings account in it. I think if when they'd come out with it, they'd called it a tax-free investment account, people would approach them a bit differently. So how these work is in 2009, Stephen Harper was like, hey, Canadians, I want to give you something. If you open up one of these accounts, you can put $5,000 into it. And this is with remember I said you either pay tax going in or tax going out? So this is with your after-tax income. So you've already paid the income tax in it. So it's taxed going in, which means when you take it out, there is no tax. All right. So 2009, you open one of these accounts, you can put $5,000 into it. Again, I think another reason why it didn't pick up traction is people were like, what's $5,000? I don't know. Then in 2010, you could put another $5,000 in. And in 2011, in 2015, the year Stephen Harper was trying to get reelected, he said, Canadians, you can put $10,000 into it this year. And then the Liberals got in 2016 and they're like, no, you can't. You can put $6,000 into it. And then it's just kind of kept going on that. Now it's based on the consumer price index, round to the nearest 500. So it is going to go up in 2025. It was $7,000 and that amount you can put in every year is going to increase. Long story short, as long as you've been 18 since 2009 and looking around the room, that's probably all of us, you have up to $102,000. Oh, sorry, I'm bonking this table. That you could put into this account today. So if you've never opened one of these, you're not doing anything with it, and you come across $102,000 of personal tax-free after-tax money, you could open one of these and put it in there. And this isn't that odd. Where I see people doing this is with inheritances. Inheritances are becoming a big part of my planning every day, right? Is The population ages. We're now talking about estate planning, inheritance, or selling rentals. Some of the more senior agents that I'm talking with, they're like, I built this big real estate portfolio over the course of my career. I'm now starting maybe to sell off or do different things with it or restructure my business. And they have these big chunks of personal money. So we're going to put $102,000 in this. And again, you have to invest the money in this account. How many of you, and you don't have to raise your hands, have one of these or 4 of them, and it's all just in cash? Because every time you go to the bank, they're like, you should open a TFSA today. And there's just cash in it. Or maybe you bought a GIC and it's come up for renewal and you didn't renew it and now it's just in cash. So invest these. Do it. I'm not talking about investing today. Want to talk about investments? I'm happy to go through that with you, but stocks, bonds, mutual funds, whatever it is you want to do with it and grow it. So let's pretend you do that. And you now grow the value of your TFSA to $300,000. You can put cryptocurrency in these. You can put like whatever is a legal investable asset you can own in one of these corporations. So put your crypto in there. It's going to go to $300,000 and you've never paid any tax on it. So if you have this account with me and you call me and say, hey, Joe, I want to drain my TFSA today. I found a cottage I want to buy, or I want to help my kids with their down payment on their house, or I want to blow it all and go to Vegas, whatever it is you want to do, you can take that $300,000 out in the same day and pay no tax. That's it. It's just yours. Zero tax implications to it. But the beauty is this now becomes your contribution room for January 1st of the following year. So if you emptied it today, April 30th, took the 300 out, January 1st of next year, if you happen to have another $300,000 of personal income, that becomes your new contribution room, not the 102. So there can be some planning opportunities here based on projected cash flows and how we want to move it. Yes, go ahead. Plus whatever the next year's amount is. Yeah. So it's another $7,000 on there. Yeah, correct.
All of the growth that is created from that account does not get taxed.
Nothing. Totally tax-free. And that's why it makes me sad when I do like our analysis and I see people's TFSAs and there's like, they just don't use them. Because again, it has the words or nothing in it, savings account. So people they treat it like their checking and savings account or like another kind of bank account. They're really not using it to invest. Whereas these are incredible investment tools.
And I'm sure that there's a guide.
Yeah, any of your standard kind of, like I said, you want to pick your own stocks, you want to mutual, whatever it is, you just open the account if you do it on like a Wealthsimple or Q-Trade account, you can just pick from their stuff. If you open it with me, I put my portfolios in there, like whatever it is. Yeah.
Maximum contribution is 102,000.
As of this year, as long as you've been 18 since 2009.
It can go to whatever.
Yeah, it depends on what you invested in. So there are some people that their amounts in their TFSAs could be in the millions, depending on how they invested that over the years. But that's the exception, not the norm. Yeah, and these are just going to keep getting bigger, right? Because every year you're just adding more and more contribution room to them. So now they're what I'd say is a viable tool. Like I said earlier on, I think because the amounts you could put in were so insignificant, people didn't really pay attention. But I don't know, having $102,000 worth of space in a tax, there's only 4 things in Canada that are tax-free. The money in your tax-free savings account, the sale of your primary residence, winning the lottery, and the proceeds of life insurance. That's it. That's it. So don't quit your day job. But that's it. So if there's only 4 ways we can generate wealth tax-free in Canada, why wouldn't we optimize one of those? The other ones we can't really, I mean, I'm not going to talk about lotteries. So the last part I want to talk about here is around beneficiaries. So when you set up one of these accounts, there's a section that you have to fill out, what's called the beneficiary. If you're DIYing this and you're on like Wealthsimple, you'll just click something like my estate. What you want to do is if you have a spouse, you want to make sure your spouse is named as what's called the successor annuitant. Okay? And what this does, and it's only your spouse that can be this. No one else can be the successor annuitant. And what this means is that if you die, your spouse inherits the whole TFSA account, plus the money that's in it, and the rights that go on with that account. So they now become the new successor of the whole TFSA account, so the money can continue to grow tax-free. and they don't have to withdraw it, and so they inherit. If you don't have a spouse and you do name your estate or your kids or whoever it is, then they'll get the $300,000 tax-free. That's fine. They'll just get 300,000, but the account is then closed. Okay, so it's just, again, that when part of our planning process, when we bring clients in, is we look at how you have your beneficiary structured on all your accounts to make sure that it makes sense. Because this is a really, I don't know, if I'm the spouse and I don't need the money, I'd rather have the full TFSA account and have the money keep growing tax-free rather than it be cashed out.
Spouse is a very.
Or common law. Any definition of spouse in Canada. Yep. Yeah, okay, so that's it for TFSAs. And yeah, go ahead.
Sorry.
No, that's okay, Nelson.
So you said since 2009 up till today, you contribute $102,000.
Correct.
And then you said if that example, if it grew to 300,000 today.
Yep.
And then you pulled it all out, and then next year you'd be able to put that 300. I thought you could only put
The 102 back in.
102. Okay, fair enough.
No,
Okay, good.
that becomes your new contribution limit.
And contributing toward our TFSA.
Yeah.
I gotta get on my laptop and make some.
Go ahead.
Make a bank account. Change my number.
I'm sorry.
The remainder of 52,000 this year.
Yeah, you can top them up anytime as long as you don't exceed whatever your limit is. Yeah, and you can have multiple TFSA accounts at different institutions as long as the combined total of all those accounts doesn't exceed your maximum. Yeah. Go ahead.
So if I had like $50,000 stock in my TFSA.
Yeah.
Double to 100,000. I don't have to pay tax on that 50,000.
Nope.
What if I wiped out that entire 50,000? Can I break that off that capital loss?
You don't need to. It's all tax-free. Oh, like if you lost all the money. No, so then there's a capital loss in the account, and you're just SOL.
That makes sense.
No, it's not like in a corporation. Okay. Good. All right. I can open these accounts, by the way, just if anyone wants to know. Okay. So the next, oh, actually here. So let me stop sharing. Okay. See, and that's the difference between having a person that manages your investments and a planner.
Yeah.
Okay. Oh, why did it? Where were we? So recap on that. Sorry, when I switch screens, it kind of. So what's the difference between the two? And the question I'll get from agents is, okay, well now, which one do I use? RSP or TFSA? If I only have a bit of money every year to invest, which account do I put it in? It's going to depend. One of my sort of golden rules, if you're ever getting investment advice from anybody and they start using words like always and never, stop listening to them. So if you talk to them like, oh, you always do your TFSA first, or you always do, like, financial planning is so unique and so individual. There really is no one rule that applies to everybody. And same as building wealth, there is no one trick that if you just did this one thing, we'll all be wealthy tomorrow. And this quick hack, like this isn't TikTok. Building true wealth is about doing 10 little things properly over a long period of time. Right? And so that's kind of the difference. So how do you decide? It's going to be based on your income and your fluctuations. It might change year over year based on how much you make. What are the other sources of household? My computer's picking up someone's mouse here. Okay. What household income coming in? Because whether you do an RSP or a spousal RSP or where you contribute that year might depend on if you sold a rental that year or not, or if your spouse retired, or if they haven't, like, there's a lot of factors that go into it. And then remember I said at the beginning, my job is to look ahead for you. What does this look like 10 years from now, 20 years from, and 30 years from now? I'm looking ahead at, okay, now when we're 75, what do you need? How's that going to be taxed at that point? And what are all these different sources of income later on down the road? That inheritance piece, I start talking about that more now. I just see it coming up more and more. And that marital status, as you could see from the beneficiaries, a lot of it is if you have a spouse, because if you have a spouse, how we structure these is going to change as well. Whereas I work with a lot of single agents and the spouse isn't a factor. So how we build their plans is different. Okay, so now let's talk about CPP and OAS. I'm going to go back to my handy dandy camera. All right, so CPP, OAS. Whoops, there we go. Canada Pension Plan, old age security. These are different things. They are not the same thing. People interchange them all the time, especially the younger generation that's not really thinking about that just yet. CPP is based on your contributions. And your contributions are based on if you worked in a salaried or earned income kind of environment. So if you're a Canadian and you've never worked a day in your life and you've never contributed to CPP, you will get nothing from it. Okay. So when I talk to, again, younger agents, they say, I don't want to invest in CPP. I don't want to pay CPP. Well, you don't have a choice. It's not going to be there for me when I'm older. And that's not true. It's extremely well funded. There's 675 billion in assets in this pension fund. It's one of the best managed pension funds in the world. If you have contributed to CPP, you will get your money out of it. Okay. Whereas OAS is based on residency. So it has nothing to do with whether you work, whether you've contributed, whether or not. This is truly a taxpayer funded program. It's a social security kind of program. It's designed to keep Canadians out of poverty in retirement. So it doesn't matter where you've worked or not. They're very different. Will this be there in the future? I have no idea. Probably. But if I'm talking to an agent that's 28 years old, who knows what this is going to look like by the time they're 65, right? Okay. The one thing you have to know is these are both taxable sources of income in retirement. Again, some people think that because it's coming from the government, I don't have to pay tax on it. That's not the case. So both of these incomes, once they start coming in, add to your taxable income for that year. How it works in 2025, this automatically starts at age 65. So you don't have to opt into it. The year you turn 65, this will just start coming to your account. It's about $780 this year. You can opt out of it and delay it to age 70. Most people don't. You just take it. For anyone in the room or that's listening on the call that might be turning 65 this year, just please know that this is called means tested. So how this is going to work, you turn 65, boom, $780 starts showing up in your bank account. And then the next year when you file your taxes, if you made more than 90K of net income, they start clawing it back 15 cents on the dollar. It's called the OAS clawback. Because again, this is a social security program designed to keep Canadians out of poverty. And they think that if you make $90,000 of net income in a year, you probably don't need old age security. And it is totally gone by about 145K of net income. So if you're making more than 145K of net income when you're 65, you don't get OAS. But they come back and they say, oh, shoot, sorry, we shouldn't have paid this to you. Please pay it back now. So, and I've had some people get caught with that, like some agents, right? They turn 65, it shows up, and then they file their taxes next year, and then they got to pay 20 grand back. And so it gets checked annually based on your tax return. So let's say you're still working in real estate until you're 70, so your OAS gets all clawed back. You don't have any of it. But the year you turn 73, you've got no other income coming in, you file your taxes, they'll go back and start paying it to you again. So every year they're just going to evaluate whether you get old age security or not based on your income that you file on your taxes. Good? Okay.
Wise, you getting CPP at 60 or 65?
That's a great question. Let's talk about it. Okay. So a couple things before I get into when you should start collecting your CPP and how it works is just know that as a real estate agent, with or without a Prec, you are both the employer and the employee. So you're paying both halves of this. If you just had a regular job and you worked at Tim Hortons and you got your paycheck every day, Tim Hortons would pay the employer half of CPP and you would pay the employee half of CPP. But because you're self-employed, you get to pay for both. How much is it that you're putting in every year? I could literally do an hour-long conversation on this. I'm not going to. Really high level, if you make about 80K in a year, you're going to max out your CPP contributions, and they're about 9K per year. Rough. And it's graduate up. So if you only make $40,000 a year, it's a proportional to your income. But once you start making more than $80,000 of earned income to a year, you don't keep contributing to it. Okay, so they just sort of cap it out. They really changed the CPP rules over the past 2 years. And they've added this like CPP enhancement to it. So there's a lot of moving parts to it now, but just know that that's kind of, if you don't have a Prec, you're paying CPP on about the first $80,000 of income you generate. So you go your whole life. You only start contributing to CPP at age 18. So that job you had working at McDonald's when you're 15 doesn't count. So at age 18, you start contributing to it. And you contribute your whole life. And how much you contribute throughout that lifespan depends on how much money you made in that year. If you took years off to have children, then those years don't count. So the calculation for how much you'll get from CPP is very individual. And I can help you with that as well. But let's pretend you're a good little Canadian, you work hard all those 43 years, and at age 60, you're going to get a letter in the mail, and the CRA says, do you want to start your CPP today? So this you have to opt into. And if you started today at age 60, the CRA does not like that, and they're going to ding you by 36% less. Because they don't want you to start taking it earlier. They want you to leave your money in because it's invested in growing. However, if you delay to age 70, the CRA likes that, and they give you 41% more. And that could be quite significant over the course of your lifetime. So most people go like, well, then I'll just wait until age 71. I'm still working in real estate. I don't need this extra $1,000 a month right now. Let me delay it. But do you remember what else I said starts at age 71? Your RIF minimums. So now in your 70s, you could be in a situation where you've got these high RIF minimums coming in, and you and your spouse will have CPP and OAS coming in. Maybe you're still selling houses, and you could end up in a high, and maybe there's a pension in there, right? If one of you was a teacher before, and now there's pension income coming in, you could find yourself in a higher tax bracket in your 70s than you were in your working years, because once these faucets of income are turned on, you can't turn them off again. Like they just start. So to your question, when do we start this? The other part that I want to talk about is what happens to CPP when we die. So you go your whole life, you contribute money to CPP. Don't ask the CRA how much you've contributed. They're not going to tell you. You can request a ledger. It's really, really long and complicated, but let's pretend over the course of your life, you've put $200,000 in your CPP account. If you die without ever making a withdrawal and you have a spouse, your spouse will get up to their maximum. So the CPP, like the CRA will just say, like, this is how much your spouse could have maxed out their CPP. If they're already collecting their maximum, they get none of yours. Sorry, you'll get $2,500 taxable to the estate. And your kids or your estate gets nothing. So when you hear people complaining about CPP, this is usually what they mean. I contributed my whole life. My father passed away. We didn't get anything from it. It's a scam, blah, blah, blah. It's a pension. That's how also most workplace pensions work as well. But there is no like my spouse gets 30% of my CPP because I put into it. It's based on what your spouse's CPP is. So to answer your question, there is no right answer. It really does depend on the individual. And again, what are those sources of income going to be later on? And how much do you need later on? And there's been times I've made recommendations after building the plan that was like, you need to start this at age 60. And other times I'm like, you're probably going to run out of money by the time you're 80. You should probably defer this to age 71 and get as much as you can out of it. So it really depends. But if you don't want to hire a planner and you want to figure this out on your own, if you think you're going to live to be 80 years old, barring any unforeseen circumstances, you're healthy, all that stuff, and you think you'll live to age 80 and you start collecting at age 65, you'll break even. You'll get all the money out of it that you put into it. So if your whole goal is just, I don't care about CPP, just when do I take it, whatever, most Canadians start taking it at age 65. So longevity is the single biggest, not the single, but one of the deciding factors around when we start this. Okay? Any questions about CPP? The last part I'll say about this is if you have, my picture's getting a little thing, a Prec. And I'll talk about this yes, go ahead. That's, yes.
Why is it? Stop working at 6, 7. So, why can't I call them up like this, saying, like, it's the banker? I want all that money out of here.
You can't. So it's a pension plan. It's called the Canada Pension Plan. It's a mandatory contribution based on people that work in Canada, and it's designed to force Canadians to save for retirement. Yep. It's got to come from your own wealth. It's not coming from this pool. I am not getting into politics today.
At 65, they pick the 6%.
No, so it's a graduated amount. So it's 0.6% per month and decrease until age 65. And then age 65, it's 0.7 per month that you delay it, you get more. So if you started at 66, you'll get your base amount plus 0.7 per month that you've delayed it more. So it's a graduated 65 is the right in the middle. And if you take it earlier than that, they decrease it up to a maximum of 36% if you start right age 60. And if you delay it after age 65 at various points in time, you'll get it's a little bit more. Yeah. So again, I was way oversimplifying here just to get the concept that around delaying or starting early. Yes, go ahead. You can. Yep. It's called a post-retirement benefit. So for agents that are still working after age 65, so one of two things that happens at 65, if you're still working, you can elect to not pay into it after age 65. So up to age 65, you have no choice. If you're working, you're contributing to this. After age 65, you can elect to be like, I know I'm working, but let's stop this. I don't want to keep contributing to this. But some Canadians do. They still want to keep contributing to it into their 60s and 70s if they're still working, if that's their only pension they're going to have. If they're working, at Home Depot part-time and driving a school bus and they don't have any other sources of income, they're going to keep wanting that CPP built up so that they can get an extra $1,000 a month maybe. Because again, if we're looking ahead and them planning on living until they're 95 years old and there's no pension, there's no real estate, there's no nothing coming in, it can literally be thousands of dollars of difference in a year between delaying it. 71. Everything just stops at that point. So if you're still working at age 80, you're not contributing to it anymore. Yeah. Good. All right. So let me go back to my screen, my PowerPoint. So how this works for you, like I said, as a summary. Oh, no, I'm not. Hold on. I'm sharing the wrong screen here. Where are we? Zoom. Help me out here. Share. No, where's my PowerPoint? Give me one sec. Can you guys see? Oh, there we go. Oh, I stopped it. I'm sorry.
It just delayed a bit. No, it's back.
Okay. I'm used to working on two monitors, so
I'm just trying to check.
share. There we go. All right. Beautiful. No, a little delay here. Okay, so how it works, remember, you're both the employer and the employee. You're paying both halves. Question is, how much can you expect? And lots of people just don't know, and that's a big part of retirement planning. How long do they keep working for? How do they not? So we help with that as well. And it is based on your earnings history throughout your entire lifetime. Old age security, remember, it is going to get clawed back. I had this statement there that said, is this a priority for you? And when I talk to people, especially in their 60s, as we're doing retirement planning, some people are really passionate about their OAS one way or another. Like I work with some very wealthy people and they're like, I don't want my OAS clawed back. Like they're willing to live below the $90,000 of net income just because it's so important to them, because they're like, I want my OAS. Like it's just this, it's like the overarching whole theme to their plan. And then I have other people that are like old age security. It's a social program. I've done well in my life. I don't believe I should be collecting it, and they'll actually donate it to a charity, even if they do get some. So it's a real, again, an emotional thing. It's nothing to do with numbers, but no judgment for me either way. I'm here to educate and help you make the best decision that's for you. And just know, where your different sources of income are coming from. So I am going to talk a bit now about the Prec. And again, this concept of this was my life before my corporation. Now I've got my corporation and all hands on deck. I'm just going to focus on my corporation. So let me go back to my camera. And let's talk. So I'm not going to, all right, that's that. Over here. Oh, that's super blurry. Sorry, guys. There we go. So Prec stands for Personal Real Estate Corporation. I have no idea who of you in the room have one or don't, or who on the call does not. So I'm going to speak right back down to the very, very basic level. What happens once you incorporate your business is, so you're up here making money, selling houses as an agent. Okay? Before you incorporate your business, there's no difference between you and your business. You and your business are one, you file taxes together, it's all sort of looped in together. Once you incorporate your business, there's now a separation between the two of you from a tax perspective and a legal perspective. So you are now over here as a shareholder as well of a corporation, and these are separate entities. Okay, you as a person have a SIN number, your corporation has a BIN number. So now when you form your corporation, instead of the money coming to you as an agent, it bypasses you and goes into a corporate bank account. So you reach out to the Fulton sisters and you say, hey, I incorporated my business. You get a corporate bank account and they start paying your commission checks into this corporate bank account. So your GCI goes in here. Let's pretend you do 250K GCI in a year. You've got $50,000 in expenses. You've got desk fees and photographers and home stagers. And you need another 100K to live your life, right? You've got kids in sports, groceries, mortgage payments, all that sort of stuff. This leaves you with 100K left over. This is called a retained earning. And this is left in the corporation and is only taxed at 12%. So this is where most agents start to think, I would much rather pay 12% on this money than 54%. So, and again, I have a whole other presentation I do called Prec Now What, where then I talk about, that's it. You have a Prec, now what do you do with it? I'm not getting into that today, but in regards to CPP, RRSPs, and TFSAs, I want to talk about it. So this 100K, you pay your 12%, and we do corporate investing. That's a conversation for another time. But what I want to talk about was this 100K that you need to take out to live your lifestyle, right? So the rest stays up in the corp. You got to take this money out to live your life. You now have a choice about how you take that out. You can pay yourself as though you are an employee of your own corporation. This is called taking a salary. This is going to give you T4 income. It's going to be taxed at whatever the tax rate is based on the amount you take out. So if you take out 50 grand in a year, it's going to go 50 grand towards your taxes, 100, whatever it is. It's just the personal tax rates on it. The beauty of this is now an expense to the corporation because it's payroll. So the eyes of the CRA is like, there's a corporation, this is a business, they have staff, so you can write off payroll as an expense. Whereas when you're a sole proprietor, you can't write off your own income as an expense to your business. So that's a benefit. And this is what's called earned income. Remember I talked about that before? So you are going to contribute to CPP. So the corp's going to pay the business owner half of CPP and get a credit for that, and you will pay the employee half of the CPP. So it kind of divvies that up as well. So that's one of the benefits. And you are going to generate that 18% RRSP contribution room. So again, if you pull out 100K, you can put 18% of that into an RRSP. I think that's kind of what I want to say there. There's a whole bunch of different things you can kind of do if you pay yourself a salary. And just remember that our world relies on T4 income, right? You want to get a car loan. They're like, oh, how much is your T4 income? You want to get pre-approved for your first mortgage? How much is your T4 income? And when CERB was a thing during COVID, that was based on T4 income. So there's some considerations here about whether we do this or not. The other way you can pay yourself is though you have that shareholder hat on. Okay, so now you're the business owner. This is called taking a dividend. This is going to give you T5 income. And this is viewed as taking profits from the corp. So it is not earned income. And I know you're still like, oh, but I earned that income. I went out, I sold that house, I busted my butt, I put up with those people, I earned that income. And that is true. But if you elect to pay yourself via dividend, the CRA sees it no different that you happen to own some shares in Amazon and Amazon paid you a dividend. You didn't earn that money. You just happen to own shares of a company that paid out a dividend. So because it's not earned income, there is no CPP contributions because CPP is only based on earned income. There is no RSP contribution that you can make. Like it's not generating that RSP space. It is much tougher to qualify for things based on T5 income. After a couple years, and this is the Prec conversation is going to change over time. Right now, they've only been around for 4 years. So, and if you waited to get one and you've only had a Prec for 1 year, if you go out and try and qualify for something with T5 income, the lenders will probably laugh at you. Whereas 10 years down the road, if you've just consistently paid yourself 100 grand in dividend income and you give your corporate statements, it's fine. But you just have to understand that this is a separate entity that needs to build up its own credit and its own tax history and that sort of stuff. Okay. And so how do you decide salary versus dividend? Yes, you can do a mix of both. There's a whole bunch of considerations there. I spend a lot of time with real estate agents helping them figure this out and what's best for them. And again, there's no right question. If you go to your accountant, most accountants fall in either team salary or team dividend. They just do. But it's really an individual situation based on all that stuff that I just talked about. Do you have a spouse? What are your rental properties doing? How are we going to fund yourself in retirement? What's the future tax bill going to be? And that really determines how we structure this. Cool. That's all I'm going to say about Prex for today. That's good. All right. So back to the PowerPoint. Yes, go ahead.
Can you buy insurance from the right,
Yes. So
and draw money from as a line of credit?
yeah, so that's called an IFA. Okay, it's not that simple. So the question is, can you use your Prec to buy life insurance? So yes, you can use your corporation to buy different insurance policies, to buy critical illness insurance or life insurance. It is one of the only ways. So once you have a corporation, you have wealth in there, you open up a corporate investment account. It's a non-registered account. So there's no tax benefits to it. Like your corp can't have a TFSA. Your corp can't have an RSP. So it's just a non-registered account. And just so you know, inside of a corporation, passive income's taxed at 50%. So if you own a GIC in your corporation and you get your, well, today it's like 2% rate of return, that 2% rate of return is taxed at 50% if you hold a GIC in your corp. Whereas if you hold a GIC in your RSP, you'll get the full rate of return because that's a tax sheltered environment. So just no passive income. So what you're talking about with insurance policies, depending on the insurance, and I do this, I'm insurance licensed, so I make recommendations on this as well. Your corporation can use that money, that after-tax money, to put money into a cash value life insurance policy that pays dividends. And that's the only way to grow your wealth tax-free inside of a corporation. So you funnel money into these policies every year, every month. The policy pays dividends. Those dividends are all tax-free inside of the corporation. And what he's talking about is then leveraging that. So there's a cash value that builds up. You can now use that as collateral at the bank to get a line of credit against it. And so it's a very, I have a presentation called Assets to Empires, and those are advanced planning and wealth building concepts where I talk a lot about that. But high level, it is. So we can chat offline, or I can put that presentation on and talk about insurance. And like,
that's a good one for you. Yeah.
Okay, let's do that. Yeah, I'd love to do that. Yeah. And because there's no one presentation I can.
Because that's what they're paying tax.
No, I mean, you just have to understand that the leveraged loan, though, there's an interest rate on it. But anyways,
Interest rate is much less than the tax.
you are absolutely right. So yeah, it's called an IFA if you want to Google it. Yeah. So yeah, I cover that in like the more, once you have a Prec, once you have the retained earnings, then there's some fun things we can do with corporate wealth building strategies.
The people who the insurance agents, they don't know much about.
It depends on the market they work. And so corporate, this is another thing too. Corporate planning, in my industry, a lot of agents just don't do it. And if you're working with the bank, once you have a corporation, it's just a whole other beast. And a lot of advisors just don't work in that space. So if you work with VAR, ask them, how many corporate clients do you have? How many corporate accounts do you manage? Because there's just all these nuances to it that are very unique and they don't get it. And the more dangerous ones are the ones that have done it once and they now give really bad advice. And the worst advice, and I will move on to this around life insurance, if you own a personal policy, so no Prec, right? You have a life insurance policy, you're paying for it personally, and now you incorporate your business. The insurance people, and I'm one of them, but the people that don't know will say, oh, let's just do a change of ownership form and make your corporation now own this policy. And now the corporation can pay the premium, so you don't have to take it out and pay the premiums with after-tax dollars, and you just filled this change of ownership form. That's not how it works. Okay, so if you're ever talking to an insurance advisor that just says to take a personal asset and just throw it inside of a corporation without an actuarial, it's an asset, right? The corporation has to buy it at fair market value. There has to be an actuarial assessment. So it's not that simple. And if your insurance person is just truly like a Manulife insurance sales guy, pardon? Yeah,
The beneficiary of the policy.
is then the corporation. Yeah.
Can I pay the tax? Yes, yes.
Depends on what the cash value was and the fair market value when it went in. So when the policy then goes in the court,
$35 million.
Okay.
You're buying something like that, you can't be this for
No.
You know.
Correct.
That money, this how much tax the beneficiary is.
so when the life insurance policy pays out inside of a corporation, it creates something called capital dividend account room. So if there's a $5 million tax-free payout to the corporation, it creates a $5 million CDA account room. So then the money moves out to your estate tax-free that way. So there's no taxation of life insurance. They're amazing. I love life insurance. Okay. Okay, so why you still need personal savings. So once you have your corporation, like I said, I'll see agents now, they're like, I'm just going to take out the bare minimum for my corporation to fund my life. I'm going to leave everything up there. But then what happens is at some point in your life, you're going to need personal cash, right? The house will need the roof replaced. Your kids might need help with the down payment. You want to buy a cottage and you don't want to be drawing 50 grand a year, 50 grand a year, 50 grand a year. Oh, shoot, my kid's going to Harvard. I'm going to draw 100 grand a year. So when we do what's called a compensation analysis about how much money we're going to need, it's better to take out 60 grand a year every year, keep your TFSA full, keep that personal liquidity. So in that year, 5, 10 years down the road, when you have this big capital expense, you're not forced to withdraw it all from your corporation 1 year. So that's why I said it's not one or the other. Your Prec and your real estate business and your personal life and your spouse, like it's all very connected. So once you get a Prec, RRSPs, like should you keep doing them? Like take money out of a corporation to defer tax, to put it into an RRSP, to build it there, to then figure out how to take it out later. Most times I don't, personally, my planning style isn't really to do that. I do still like trying to keep incorporated business owners with their TFSAs full. To me, that make like again, because it transcends the estate better, gives you that personal liquidity. Insurance. So I used to have some slides on insurance in this one, but it made the presentation way too long, so I took them out. But yes, you should probably still have some personal insurance and insurance inside the corporation. And just make sure that all these wealth building goals are aligned between the two sides of your life. So the biggest financial mistakes agents make. Who sees a FSBO sign and feels like angry or upset or frustrated? Because you drive by these signs and you go, I know that if they hired me as a real estate professional, even with your fee, you're going to get them more money for the house. You're going to sell the house faster. It's going to be more legally compliant. It's going to like all the reasons why you would get in front of a FSBO owner and be like, please hire a pro. Agents FSBOing their finances. Exact same thing. So you're out there and you've got your wealth simple. You've got your neighbor's buddy who used to do this, and your uncle shows up at Christmas and tells you this sort of stuff. And you're Googling things because you're trying to FSBO your finances, but there's no way you can know all this stuff, right? Same as I didn't sell my own house. I didn't buy my own investment property. I hired a real estate agent because I can't know that stuff. So if there's one like wealth building trick, like just reach out to the pros that know what they're doing. And it just, for all the same reasons that you know why you hire a real estate agent. Second base thing is just not saving enough for taxes. The agents that have been doing this a long time, you have your system. You're good. Agents in those first 5 years, this could be a really rude awakening, especially if they came from an employee background where they had taxes were deducted at source. Getting stuck in that like shitty sort of tax loop is really, really hard to bust out of. Sorry, I swore. And then again, not managing these incomes, right? So I said some months you go, it's like drought, $500,000. So in that month when you make $500,000, what do we spend it on? Like, how do we then disperse it? How do we then manage it? But then you're right back out selling again. So it's just this, you spend too much. And then when I'm doing plans, it's just not real estate agents, all people are very like in the now, right? What am I doing now? I saw the great deal now. This is what's on my internet right now. And they're not looking ahead. So you buy a lot of real estate. Great. I love real estate. I'm not here to talk you out of investing in real estate. Love it. But then when you have your cash investments, I see you taking on excessive risk. Tons of crypto, tons of precious metals, tons of alt investments, because you're like, I've got this big real estate portfolio that's growing at your steady, kind of 2-3%. And so for some reason on the cash side, you're trying to make up. I don't know what it is, but I see it all the time. And just these investments being not at all in line with the bigger picture. And everyone underestimates their insurance needs. How to structure it, where to critical illness, disability, you're self-employed. There is no WSIB for you guys. There is no EI. So, and you are your wealth. If you guys can't get up and drive to your listing appointment because you slipped and you have a concussion and you can't stare at a screen because you get dizzy, all those things, you have to take a year off to pursue cancer treatment, like your business is done. Not done, but will, depending on the structure, like suffer significantly. So it's your single biggest asset is yourself. And for some reason, we need to ensure that. Okay. So what do we do? Automating savings is really hard for your industry, again, because of this fluctuating income. You can't just be like, oh, save $500 a month, because some months you might not have $500. And other months, like I said, you could have $500,000. So what I do for my clients that have their investments with us, we do quarterly touch points. So every quarter, once the quarter's done, you get an email from us that says, hey, Nelson, how'd you do in Q1 of 2025? You had this, and we've done a plan. So we have the savings goal, and we do chunks based on the commission of the quarter. Because I learned that, I said, I can't put you on monthly savings plan. I also learned that I can't just leave you alone for a whole year and just touch base once a year because you go way offside. So that's sort of how I help. Create a tax strategy. So many different ways we can do this, but just don't get behind, set aside more. It's very distracting to your business if you know that the CRA is at the door. And then diversify beyond real estate. Again, I love real estate, but just understand, for those of you in the room that have corporations and you're now starting to acquire real estate inside of a holding company, that rental property generating passive income is now taxed at 50%. So having investments that generate capital gains, having investments that generate dividends, especially once you incorporate, really important for building that long-term wealth. Protect your wealth, get that insurance in place. And just a high level, I've seen lots and lots of agents profit and loss statements and their businesses. The best ones keep their expenses around 25 to 30% of their GCI. So if you make 100 grand in a year, aim to spend about 25 to 30% just to keep your business going. One of my bigger clients, we were having a conversation about this, and even in the years when he has a really big year, he still makes sure he spends 25 to 30%. Because it's a reinvestment back into his business. He doesn't just keep it, and that's how he grows. So if he has a big quarter and his expenses are fixed, right? You've got the photographers and the desk fees and all that sort of stuff. He has a big quarter. He'll use that extra bit and sponsor a golf tournament, take his biggest clients to a concert, or do something like that. So just always aim to keep your business around 25 to 30%, and that would be a nice, healthy model. All right, I'm going to do the case study. Everyone's still good? All right. So how we work before I get in the case study. So I build financial plans for people. So I have a 5-phase planning program. I have some flyers here. I didn't hand them out. It's also everything about me is on my website. So the 5-phase program, we go through all the stuff I just talked about. Where are you at? Can I even help you? You hire us. We charge a fee, which I'll talk about in a second. And then we get to work, and it's for your house, your whole plan, and we answer all those questions. When do you start CPP? Should you form a Prec? If you have a Prec, do you do salary or dividends? How do we invest? Should I buy life insurance? If I should, what kind of life insurance? All those different parts. And how we get paid. So going through that process takes my team and I about 25 to 30 hours of work. We charge a one-time flat fee. If you do not have a Prec, it's $2,500. If you do have a Prec, it's $3,000. And that covers up to 3 investment properties. If you have a more complex structure with multiple corporations and holding companies, that sort of stuff, let me know and I'll build you a quote. And or if you have 15 doors or 50 doors or whatever it is, I'll build you a quote. But we essentially take all that data. We use a really robust planning software. We put it like a rental property, purchase price, market value, rental income, rental expenses, assign it a 3% growth rate, and I'll show you what your terminal tax bill will be if you died age 90 holding that property. Or if you sell it at various points along the way, or what that does, or if we put the children on title because we want to get it to the next, whatever it is, so we can just build all these different models and strategies in the plan. Okay. Includes both your business and family plan, and it's written off as a business expense. Okay. It's a professional fee, just like an accountant or a lawyer. If we continue to work together once the plan is built, so you have investments with us, you do insurance work with us, then you go into like our client care program where you get the quarterly touch points and the updated plans and those reviews. But some agents just, I have a specific need. I want to hire you specifically to sort this one thing out, but I like my team at BMO Nesbitt Burns, or I like my investments, and that's fine. I'm not here to step on those people's toes. And I can complement what's already going on in the background. Okay. All right. So case study, Tara and Justin. So phase 1 of my program is called a learn and list meeting. And that's what it is. I get on a call and I want to learn all about you and just list out your questions, problems, and goals, and where are you at? So they're both in their mid-30s. She's been an agent for about 6 years, and her plan was to do this for forever. They've done a good job with their debt, some small mortgages, and she has about $500K a year GCI, but she wanted to decrease. So you can see she has a little 2-year-old. They had some fertility issues, so that's the only kid they're going to have. And she's like, I don't want to do this for the next 10 years at this, like to keep up with that amount. She's around a military town, and she's just hopping, like lots and lots of transactions. So when I met her, she had about $600,000 in the corporate bank account. I see this a lot too. Agents that form their prec, they're so busy, and there's just all this cash sitting in the corporate bank account because they're like, they don't know what else they can do with it. So she was like, probably not a good idea to have $600,000 in a bank account. And so her husband, so he's in law enforcement, had a pension, makes $100,000 a year. He hated his job, like hated it. But he was so afraid to quit or leave because of the pension, right? He's like, oh, if I can stick it out for another 10 years, then we'll have this much pension income later on. But I don't know if I'm going to make it the 10 years. But if I leave, do I like take my pension with me? What do I do? And they had some TFSAs they were self-managing. So that's their questions. She's like, how do we generate more passive income? She wasn't in the private mortgage space, so she was curious about it. I have lots of clients that do a lot of private mortgage business, so I helped with that. And this question around the prec, she's like, okay, great year. What do I do with this 600? And that's dialing down the business. But again, they had this real scarcity mentality, which I see a lot with real estate agents. I don't know if it's the culture where it's just like, you're only as good as your last sale. Like, what have you done for me lately? And you just kind of have to keep going. So they had this real like, oh my gosh, we can't stop sort of feeling. And then what do we do with his pension? Can he quit? You know, what if he doesn't get another job? All these different problems. I'm not talking to you guys this whole time. I'm sorry.
I don't, saw you touching it.
Yep, sorry. I thought that whole time I was sharing my screen.
That's okay, it was good.
Sorry about that, guys.
Mhm.
You guys were keeping up that whole time with me just rambling without even.
It was just that, it was just for the case study.
Oh, wow. Okay, let me. No, why is it not sharing? What am I doing here?
Stop sharing and share again.
Is that what I have to do? Okay.
Zoom doesn't like the.
Share
it needs like a-
screens.
Sorry.
Screens.
Oh.
No. Okay. So now I
No,
stop
it's good,
share.
it's good.
It is?
Yeah.
Okay.
I wasn't sure if you had a slideshow. Then I saw
Okay.
your finger click.
Where did it stop? Oh my gosh.
Just on when you're doing your drawing.
So you guys got the FSBO thing okay?
Oh yeah.
Okay, so that was all there. Okay. FSBOing the finances. Okay. Actionable steps, automate. How I work. What we do. Okay, case study. So there we go. There's Tara and Justin, 38. She's an agent. He's in law enforcement. So the questions they had, how do we generate income? What does she do with her prac? Can she slow down? Can he quit his job? So phase 2 is called assess and audit. So at this point, they hire us, they sign our letter of engagement, they pay the fee. We give you a link to your own secure Teams folder with a list of all the documents we need. And you just drag and drop everything in there. If you have rental properties, we have a rental property intake form we get you to fill out. Then I'll get on a call with you and we've built you a net worksheet. And I just go through it line by line and we have a conversation. Talk to me about the investment property. What's your plan? Is it a long-term hold? Is it a flip? Where do you see yourselves? And we just dig into the details of everything on it. So during this meeting, when I was asking about their investments, his parents heavily influence their investments, even though they have nothing to do with the industry. So his dad's retired and just sits there and like subscribes to all these investment kind of newsletters and just does things. And so his dad is always messaging them with like these investment
We hear you.
creepy things.
And the moms on our.
And some of it's perfectly fine. I'm not like crapping on it, but this guy was subscribing to some pretty like wild things. Okay. And they said no matter what, he wants to be fully retired by 2033, whether it was in the military or not. He's like, I'm not working past that. They want to be mortgage free by then. And they need we have a cash flow sheet. So they said we need $7K net a month to just continue to fund our lifestyle. So then we take all that and we go back and I build the plan. We put all your data into that program that I told you, and we start building different strategies. So phase 3 is called plan and present. We're going to call, I actually type up notes. And if you say, should I form a Prec? I will just say, you should form a Prec and this is why, or no, and this is why. Whatever your questions are for me, I just answer them in very plain speak. Throughout though, I will also identify any other opportunities or risks that I know about just because you didn't ask me about them. I'm still going to tell you about them. So I'll identify any other risks or opportunities I see. And we log into the software live together and I show you how I came out with whatever I'm recommending. So we built a couple different models for them. I said, look, if he quits his job today, so I turn off his income in the software, commutes his pension and invests it, this is what your retirement looks like. If he leaves it at his normal retirement date, this is what his projected pension will be. And this is what your retirement will like. And we did both of those strategies with her income going down to 250K from 500. So we stress test the plan. And we did another stress test. Say, what if your investments never have a rate of return? And so we can just, I'm trying to get them off this sort of scarcity mentality and empower them to make an informed decision. We did talk about private mortgage lending in the corp and the passive income piece and that sort of stuff. So, and then we do a full investment insurance analysis as well. So on both sides, what they currently have, what you need, and then maybe if it can be better or not. So phase 4 then is called act and implement. So we leave that meeting and a great plan is all fine and dandy. You now know what you're supposed to do. But if you don't actually do anything with it and you don't take action on it, then the financial planner in me dies a little bit because there's no point in doing this if you're just going to print it off in a binder and throw it on your shelf, right? We have to take action and implement some of these stuff. So what we did for her is our firm opened up a corporate investment account for a Prec. We got a bunch of that money going. We left a lot of cash aside because she wants to buy a triplex. So I think we only moved over about 400K of it, but we've continued quarterly to move over more. We moved her RRSPs and TFSAs, built them all new portfolios. We did increase life insurance coverage on her. She only had 100K at RBC, and I'm like, you're the primary income earner. You've got a little kid. So we just got her some really clean, simple term. And she wanted critical illness insurance, but this was actually a big surprise. She got declined. So she's 38, doesn't drink, doesn't smoke, super fit, no medications, but she has something with her liver, where the things in her liver are a bit, and she was a flat out decline. So that kind of changed our plans, right? How do we now save in the event that you have a critical illness because you can't get this coverage? He did end up quitting his job after many conversations, and then he hated the private sector even more and ended up going back. Yeah. But yeah, the grass isn't always green on the other side. They're currently saving to buy another triplex in the corp. I'm working with their account. I really wanted their TFSAs filled. I was like, you're so young. And so taking that extra out of the corp every year to fill the TFSA, it's an ongoing discussion.
We can do that.
Yeah.
Take your Prec before you pay the tax on it, I guess. Or I guess.
No, you'll have to. So that's the only thing is if you take the money out of the Prec to put in the TFSA, it adds to your taxable income.
And then put into TFSA.
Yeah.
Okay.
And it adds to your taxable income for the year. Yeah.
That's
So how much do we do and how do we get them filled? It's an art, not a science. So phase 5 then's called, so then we did all that, and financial planning isn't a one and done, right? It's not like I meet with you once, so here's your plan, carry on for the next 30 years. These are constantly evolving and moving documents, your lives change. So phase 5 is called monitor and move. So again, we do those quarterly touch points, annual reviews, available as needed, monitor your investments. So this is a screenshot of kind of her investment platform. Ongoing dialogue with him, again, as he quit and then didn't quit. Touch point, stretch it. We did open RESP for a son as well. So we had a big conversation about what do you feel about post-secondary education? Is it something you want to fund? and just monitoring investments. And I did actually have to step in with the in-laws because they were now then forwarding me his emails from them. And we're like, what do you think about this? And they were like, stock market's going to end tomorrow. And she's like, do we sell? I'm like, oh my gosh, I can't. So we had to kind of have a big family chat about my investment philosophy and how it's structured and why it is the way it is and make sure we have cash on the side, all that sort of stuff. So it's been education and support with ongoing active management. That's the politically correct way to say it. So that's it. I do have a branch of my firm called Answer Wealth Planners where I work with non-real estate agents as well. So I spend 90% of my time in this space working with people like you, but I have clients that are not real estate agents, and most of them are referrals from real estate agents, right? My client just sold a house, they're downsizing, they need a plan. What do they do? So we can, and it's the same system, same process, charge a planning fee, and just help people decide, even just CPP, OAS, that kind of stuff. We help there. So that's it. Thank you. No problem. Questions, comments?
I had someone ask if they can make an appointment with you. Dawn, put your Calendly link in there.
Yeah, and my calendar, that phase 1 learn and list meeting is complimentary. We can just get on, and sometimes I can just in that call sort of direct you where you need to go or not. So it's a very
What happened? You have to collect the pension?
in
Cannot.
your CPP.
CPP,
Oh, you can collect it overseas.
Where are you going?
We can take that conversation offline.
You get like full benefit?
That's a good question. I'm on the spot.
Only for 6 months.
Let me get back to you. And I should know this. So I'm getting so many questions now about foreign investments and owning Costa Rica is apparently the place to be.
People want to leave.
And so I'm literally, and it depends on the country we go to, if we have a treaty with them or not. So around, do we own property there? Can we shelter our wealth somewhere else? If I move out, what happens to my Canadian assets? I've got real estate, they're moving to New Zealand. So there's a specific account that works just with New Zealand. And so there's no one, like, it really depends on the country where you're going to, and what assets you have. It's a whole other beast. And I'm slowly starting to accept the fact that I think I'm going to have to work in cross-border planning.
Insurance, after all,
Yep.
it's good to take when you're young. It just make difference in the ages.
For life insurance, yeah, the younger and healthier you are, the cheaper it's going to be. But you can, just because you're a bit old, I've done,
I got one.
so remember that case study I told you before where,
Good company?
No, the company insurance are the company.
Oh, no, but I do have an insurance.
No, this is totally different. thing.
Yeah.
You're talking about.
Yeah.
I think I just heard this some time ago. A lot of people don't know about it.
Yep.
Maybe they should, just know about this insurance.
well, and even don't let age be a deterrent for insurance. Remember that plan I said where the lady had 6 million real estate portfolio and then the investments and the daughter lived overseas and the son was a real estate agent? How we fixed that problem with that $600,000 gap was a permanent life insurance policy. She's 67. Her husband was 76. He's uninsurable. He's on tons of med, heart disease, but we did a joint last to die policy with them both on it. So they got underwritten as a 64-year-old man. And she had breast cancer 3 years ago. And that was the cheapest, most effective way for them to deal with that terminal tax bill and equalize their estate, was use the money in her Prec to eventually pay out this policy to make it equal between the two of them. So age doesn't, now if they'd had something like that in place when they were 30, it would have been much less expensive. But the alternative of them not doing that and just paying the big chunky tax bill and then trying to split everything after, way more expensive. So insurance, yes, it is cheaper if you're young and healthy, but if you're older and healthy, we can still do it. But yeah, like in that case, I said she's 67 and had breast cancer 3 years ago, and he was 76 and not like completely uninsurable. He's a decline. So cool. So yeah, I'll do a presentation on just insurance and I'll make sure I share it with you guys and we can dig into the details on that.
I would like that.
Okay.
Nice to learn.
But it's just funny. So most people find insurance, they're either boring or they think you're just trying to sell them something.
Boring, but
It's important. And like you
It's
said, it
important.
makes a difference. So I've always hesitated about doing one, but I think I just need to.
Company.
I think we have enough people.
Yeah.
I think
Okay.
so too.
All right. Done. Leave it with me. I'll do a presentation about insurance. Any other questions?
Yeah,
Okay.
Dawn's scheduling this in. She's even talking about your new practice.
Go ahead.
Estate planning.
Pardon me?
Estate plan,
Estate planning, yep.
what's the criteria? Who does need that?
I would argue everyone.
Oh, okay.
Like, so even if you're single, you have no kids and limited wealth, right? You might still have a primary residence and some money in your RSPs. There's a conversation there because those RSPs, you could make a charity the beneficiary of them, and then there's no tax. Your estate gets a tax deduction. The charity gets all the money, and the CRA doesn't get anything. So having those whereas if you just pass away, the RSPs get sold, the CRA takes well, they'd take all of it because you have no heirs or beneficiaries. So I say kind of regardless of where you're at, and then the more complicated your situation, the bigger the need for estate planning, especially rental properties. I have not yet met an agent where I said, so what's your exit strategy with this property? And they had an answer.
Even like commercial properties, we see it a lot too. Like,
And they just say, well, I'll just hold it.
And then they just like die.
And they'll just say, there's like, well, I'll just die with it. And then whoever's left can deal with it. And I'm telling you that whoever's left that can deal with it, one, the CRA is very happy, and the other people hate you because they're left dealing with it. But if you're dead and you don't care, well, then whatever. But sorry, go ahead.
Yeah.
Oh, did you have a question?
No.
No. Okay. Did you have a question?
Looks like you.
Yeah, you're laying down.
I don't have a YouTube channel.
One of her presentations we did, I think we did your Prec one was on our YouTube channel. I know she should have a YouTube channel. You should.
One thing at a time. I just got on I hired a lady to do my social media,
Yeah.
and she's like, you need to be on Instagram. All the real estate on Instagram. I'm like, I've never had it. So the Instagram that is up there, apparently it exists now. That is all her. That is not me. And she'll message me when she'll be like, someone sent you a message, and I'm like, I don't know how to log in Instagram. So
I know I have your
Okay.
older presentation from the Prec, but it looks like you're doing one on May 22nd for the Prec. Now what? So
I have
That's
the
a
most
Dawn fest.
amazing office manager. Her name is Dawn. I've known her for 20 years, and she runs my life. She books all this stuff. She books these presentations. She books my hotels, and she just says go. So if I have a presentation called Prec Now What on May 22nd, then
there you go.
I do. Then so be it. But I can create any of them. Like again, if there's a topic that you're like, Joe, I think for my agents, I just did one last week called Two Precs, One Vision. It was for spouses in real estate. Because that's right.
We got
Husband
two
and
right
wife
here.
teams. Do they both have a Prec? Does one not? How do we structure this? Who pays who? Or parent and adult child, right? Bringing my kid into the business, but what do I pay for? Do they form a Prec? Do I not? So those families in real estate,
We got a lot of companies.
yeah. So no YouTube channel yet. Eventually, maybe.
You can just record all your webinars.
Yeah, there we go. Sorry, was there another? Did you have another question? No? Okay. All right. Thanks, guys. That was awesome. Anytime.
Questions I'm sure people.
Oh,
Yeah.
Oh, yeah, go ahead.
No, I'll find.
Oh, all right.
Okay. Awesome. I'll say goodbye to our people.
Okay.
All right, online people, I'm gonna log us all off.
Bye, online people. Thank you. And then I have the people that are